This is quite frankly scary. In this video, I'm going to be showing you exactly how Canada avoided 2008 and how it has no bullets left in the gun to fire to save this bubble anymore. So let's get right into this. Firstly, I want to show you this chart, and this is US private sector debt to GDP. So this is basically the debt that companies and corporations have. So you can see that that debt bubble started building in the 1990s during the dot-com bubble. And basically the US's response to that bubble bursting was, guess what? Lower interest rates, and then that will stimulate the economy. So they lowered interest rates to the floor, and then that started up the massive household debt bubble that you can see happened on this chart right here. Now, the difference is this chart and the Canadian chart are very, very similar, but it was more extreme for the US at that time within the first 10 years of that bubble forming. Now, another thing that I want to show you is the private sector debt to GDP, which again, it's debt held by businesses. And basically you can see from this chart, it did not start rising until around 2006. And essentially this is what saved Canada in 2008 was this private sector debt. Because essentially what happened was companies didn't have that much debt. So when credit conditions tightened, even though interest rates were coming down, I want to remind you, during 2008, even though that was all happening, guess what? Canadian businesses didn't have that much debt, so they were okay. And the fact is, because of that, that meant that people retained their jobs and there was less prolonged unemployment that occurred during that time. Now, another thing I want to show you, back to the US chart, which is household debt, and you can basically see how this starts falling before even the 2008 crisis hits. It actually starts falling around the start of 2008, and the Lehman Brothers moment didn't happen until October 2008, and that was really the financial system implosion. And it was a global financial system implosion that affected many other countries like the UK and Ireland, Portugal and Spain. It had far-reaching consequences. You can see that that line starts falling, and that is because credit is starting to be destroyed. This sent asset prices into free fall and created a huge recession in the US, because the US had built a lot of its economy around the 2008 bubble, and Canada has been warned multiple times that it has even greater exposure to things like the housing market bubble bursting than the US did back in 2008, and that is a scary thought, to say the least. You're probably thinking, Luke, well, what caused that crisis to happen? And a lot of people will say it was subprime lending, but data that has come out recently actually shows that's not the case. The main reason and the root cause of the 2008 crisis was low interest rates. Now, does that not sound familiar to you? Exactly the same cause as what happened in Japan. But basically, low interest rates, they fueled inflation, they forced a tightening cycle, and then guess what? That burst the bubble. So interest rates weren't actually the main cause of the crash in asset prices. I want to make that clear to you. Interest rates were just the pin being took to the bubble, but the actual crash in asset prices didn't occur until the recession hit and unemployment was widespread. And this is where people make a huge mistake, which a lot of people made from 2006 to 2008, and my good buddy Scott Walters unfortunately made that mistake, but he learned massively from that. Check out his channel in the description. In In 2006 to 2008, there was a time where housing prices were coming down, and they were coming down substantially, 20 to 30% in some areas, after a sort of mania occurred in the housing market. Now, doesn't that sound familiar? Because that is exactly what is happening over the course of 2022. And a lot of people saw that, who had FOMO, as a signal to buy, because they think that asset prices and debt markets are like a supermarket when they are not. So they think that they are getting a deal, but they are actually sticking their hand out and trying to catch a falling knife. And that is a devastating thing to do. These people unfortunately got caught up, and they were collateral damage to everything that occurred with the financial implosion. And it will probably be very similar in Canada, as we are seeing the exact same patterns play out right now. Another interesting note, if you made it through to this part of the video, because 75% of people will have left, they will have switched off, so I'm going to congratulate you on getting through to this part of the video. Basically, household debt relies on two things in order to keep rising. One is employment, and the other is people actually want to extend that credit to you. So the funny thing about those two things is neither of them can be manipulated by central planners or central bankers like people will think. So this is a huge misconception that people get wrong in thinking that if the Bank of Canada comes in and drops rates low, or the Fed comes in and drops rates low, is that will just fix the problem and you will see a massive rise in prices again. And it just won't happen. It didn't happen in 2008. And it won't happen now. And the exception to that rule is obviously during 2020. But they injected a humongous amount of fiscal stimulus into the economy. We are not going to see that happen again. I'm sorry to break the news to you. Central planners and central bankers are very, very cautious because of what has happened with inflation. So you are probably going to see smaller stimulus packages than we've ever seen before, which actually will be a long-term good thing. Now I'm going to show you some really scary charts from Canada which show you what's happening right now. So you can clearly see from this household sector debt chart that essentially we have peaked. There is a clear peak that has been formed, and if you extrapolate this chart to the longest form that I can get, you can literally see that there is no peak like this on that chart, which could mean we are heading for the biggest asset bubble collapse in the world. Economic activity is just not supporting the growth of this anymore, and you are beginning to see things deteriorate. You're already seeing Canada lose jobs, which is very, very bad going forward. Canada private sector debt to GDP. You can clearly see that economic growth is no longer supporting the debt growth in the private sector, and you can see that it has started to come down. A peak has been formed. And if you extrapolate both of these charts, which are linked in the description, you can see that no peak can be seen going all the way back as far as data goes to 1990. History has taught us that people will look back on this and realize that this was one of the most speculative bubbles ever to form in history. And history books will be written on this. Stories will be told for countless decades. There will be movies possibly inspired by what happens here. But one thing, and one thing we know for sure, is that people will say, I wish we would have known that this was going to happen. But the thing is, people were warned for decades and they just tossed it to the side and didn't believe it. Countless books have already been written on this bubble, and most people will deny them until it's too late. If you've enjoyed this video, then maybe check out this video here, or maybe check out that video there, which the algorithm recommends. Check out the links in the description. Check me out on Patreon. And if you're still here, thank you very much. And what are you waiting for? Click one of those.